Well, hello, everyone, and welcome. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us today for the U.S. Investment Analysis, a review of first quarter 2016. I'm very pleased to have with us this afternoon John Kosar, who is the Director of Research at Asbury Research. John is a 30-plus year veteran of the U.S. financial markets, spending the first half of his career on the trading floor of the Chicago Futures Exchanges, where he had the opportunity to learn how these financial markets work from the inside out. This experience early in his career became the foundation for unique analysis, insight, and global intermarket perspective that defines Asbury Research. John's also a former vice president of the Market Technicians Association and served on the MTA's board of directors. So with that, I'd like you all to join me in welcoming John. John, if you would unmute your phone, I'm going to pass you the ball so that we can go ahead and get underway. Thanks for joining us, John, and welcome.
Thanks for the intro, Cynthia, and welcome everybody. I'm going to get a laser pointer here so I can actually show you what I'm looking at as I go through the slides, and we'll begin in just a minute. Okay, here we go. Let's begin by kind of going over my background a little bit and a little bit about Asbury Research and what Asbury does. I started in the business way back in the early 80s on the trading floor of the Chicago Mercantile Exchange, back when there was a trading floor on the Chicago Mercantile Exchange, and really kind of learned how financial markets work from the inside out, by spending, I think I was down there for 17 years. I worked in most every major area of the Merc and the Chicago Board of Trade during that 17 years. And I didn't know it at the time, but what I was teaching myself was kind of an intermarket perspective on how the various markets work together, how interest rates work with stocks, how stocks work with currencies, and how some of the commodity markets fit in, especially some of the more economically sensitive ones now, like oil. Everyone's focused on oil prices now because oil prices are pushing stocks up and down. So, that was the beginning of this. My focus is technical and quantitative and a little bit of behavioral analysis, where we look at a lot of investor sentiment gauges. And we put all these things together to kind of see what's going on under the hood of the market, as I like to call it. Fundamental analysis are, they're going to study numbers. They're going to study earnings reports. Economists are going to look at, what's going on over the globe, global supply and demand. And what we do here is we kind of supply that other side of the elephant. Everything should meet in the middle. In other words, what the economist sees if he's doing his job, and what the fundamental analyst sees what he's doing his job, and what folks like us do, it should all kind of meet in the middle. So the more you see, the better it is. Clients, really up until a couple of years ago, just kind of looking down here at the bottom, up until just a couple of years ago, our clients were pretty much people that are in the professional realm, hedge funds, portfolio managers. Recently, we started to provide services for individual investors. So if there are any individuals out there, we now have something for you, and I think you're going to like what we do. This is a little more about me. I think I've already gone through this already, and you can read this at your own time. I just kind of want to give you a little bit of an idea of where I come from, so you have a better understanding of what I look at and kind of how I view the world. What I want to do today is show you what I look at, show you how we think here, show you what we think is important. And I think a good way to look at this is these various market metrics are kind of like colors in a painting. Back in the old days, you got a black and white photograph, and you could see the outlines, you could see the people, but you really couldn't see a lot of detail. I'm a huge believer in the more things you look at, the more diverse things you look at, the more you see, the more you can kind of put things together and see a little bit more detail. So when I look at markets, I'm not just looking at price and volume. I'm really looking at a lot of sometimes obscure data sets. And when I put them all together, it really gives me a pretty clear picture of who's buying, who's selling, where are they buying and selling from, what it means. So some of the areas we're going to go through, I'm just going to touch them really quick, and then we're going to look at a chart or two for each. Price and trend, it's pretty simple. We want to see which direction the market's going. It's as simple as that. Economic reports come out, fundamental reports come out. Ultimately, what is going to decide if we make any money or not as investors is what investors think of that information. Sometimes you'll have a bullish report come out. It won't be as bullish as everybody thinks it's going to be. Prices will go down. So the first thing we want to see is what's going on, what's the trend, where's the resistance levels, where's the support levels, anticipating potential turning points in the market. So our first couple of slides are going to pertain to that. And then intermarket relationships are really important these days. When I started doing this 30 years ago, it wasn't as important. Now there's a lot more globalization. The world's a flatter place. It's a smaller place now from an investment standpoint. So we keep a database here. I've actually been building this thing this is our 11th year here. So I'm building it for 11 years. A big database of intermarket correlations. What is correlated to what, either positively or inversely? Sometimes when you look at the S&P 500, it's going sideways. You can't really tell what's going on. So we know right now the S&P 500 is positively correlated to oil prices. We know it's positively correlated to dollar-yen. We know it's positively correlated to the German DAX and to several other global indexes around the world. So now I've got other things to look at. I got surrogates, so to speak, for the market that I'm looking at. So this is an important thing that it gives you more depth. It gives you surrogates if the market that you're trying to figure out isn't saying anything to you. Momentum is kind of a subset of trend. You want to see where momentum is going, and you can break that down into monthly or quarterly or whatever your investment time horizon is. So another good thing here to know, these tools are not one size fits all, but you can kind of make your tools fit the kind of investor you are, the kind of trader you are. Asbury is strategic to the quarter, tactical to the month. So what does that mean? You're going to see a lot of the charts that we're going to look at. Strategic charts for us are going to be a 63-day. We'll look at the indicator, and then we'll overlay a 63-day moving average over that. Why? Because there's 63 days in a business quarter. So I want to see what that particular indicator is doing over the quarter, because that's the strategic time frame within which we work. A tactical basis. Tactical is how we move in and out of that strategic trend. I use a 21-day average, simple moving average, over a lot of the metrics we use for our tactical ideas. Because first you need to know what your strategy is. Over the next quarter, I'm going to buy XYZ. Okay, well, how are you going to buy it? Okay, that's what your tactical does. And, for us, again, that's 1 month or 21 business days. And that will tell us within that strategic 3-month price move where we get in and out. Investor asset flows, hugely important. Hard to get the data. We've started actually watching data for ETF asset flows over the past several years. 10 years ago, the stuff wasn't even available. I used to use futures open interest back in the day. But now I'm looking at ETF asset flows because it tells me, if you look at a price chart, you might see a wild day where there's a big range. But what I want to know is who's taking this home overnight. There's a lot of stuff that can go on intraday. There's high-frequency trading. There's a lot of activity that goes on intraday that represent really day trading and not, the conviction to hold something overnight or, more importantly, hold it over a weekend. So I want to see who is buying this stuff and taking it home with us, or who is selling this stuff in front of a weekend. So I have an idea of what their level of conviction is, positive or negative. So we'll look at some charts there. Credit spreads. We look at two different credit spreads that have to do with the bond market. We look at high yield and BAA corporate bond spreads. Why? Because over time, when these spreads start to widen, indicating the bond market is pricing in more credit risk for these companies, the stock market really doesn't like it and either goes sideways or goes lower. It starts by going sideways, and if these spreads continue to widen, it pushes stocks lower. The bond market, in my opinion, is a little bit more forward-looking and a little more prescient than the stock market. The stock market tends to very much trade from number to number. Jobs today, CPI tomorrow. You know, Yellen's going to speak the day after. It's point to point to point to point. Where the bond market, I think, tends to look out over the horizon, and it gives you a little more of a steady and easier to discern idea of what those folks are thinking. So credit spreads is something we're going to look at also. Volatility, going over to the second column. Volatility is important because, like these credit spreads, it's a fear gauge. It tells you if the market's afraid or if the market's feeling confident. Fear and greed, what I learned on the floor, are really the primary drivers of day-to-day activity in these markets. How we as investors perceive the news, perceive the data, does it make us feel greedy? Does it make us feel fearful? One way to look at that is looking at various volatility metrics. I like the VIX. I know there's other ones out there, so we'll look at that. Investor sentiment. We look at investor sentiment. We look at a lot of it. We look at survey-based investor sentiment tools. What are market letter writers thinking? Are they bullish or bearish? What are hedgers thinking, commercial hedgers? We use the COT data for this, commitments of traders put out by the CFTC. I won't have time to run into that today, but that's a set that we use. I want to know what traders are thinking. I want to know what investors are thinking. I want to know where people are positioned in these markets, where they see value, where they see excess. Let's go to market breadth is next. And market breadth, very simply, is how many cylinders is the market actually running on? You want to see strong breadth. In an index, you want to see, let's take the S&P 500. One way to look at that is to see how many of the constituents in the S&P 500 are trading up above their 200-day moving average. When there's a lot of them, it tells you there's a lot of participation. Everything's going up. That's good. That's like if your car's going up a hill and you got an 8-cylinder car, all 8 cylinders are banging away and you're going up that hill. Sometimes what you see, and we've seen this, is where you'll get a handful of stocks that will drive the markets up, a handful of big cap stocks, like a Facebook or Alphabet, formerly Google, stuff like that. You might get 6 or 7 of these, a handful of these things, the FANG stocks, and they are big enough that they can basically pull the stock up the hill, but you don't like to see that because without that bigger participation, trends are hard to sustain. Overbought, oversold. A very simple indicator, often misconstrued, often misinterpreted. I want to know if the market's cheap or if the market's expensive, and this is one way to tell me. Finally, seasonality is what does a market statistically do over a period of time. We look at seasonality in 3 different time frames. We look at annual, quarterly, and daily. So we will look at those. By the way, this is a big seasonal period for the stock market. The S&P 500 historically, based on our data, which goes back to '57, which is when the S&P started to, when it evolved into its current iteration, let's call it. The S&P 500 peaks for the quarter, either this week or next week, and peaks for the year in the month of April. So this is that sell in May and go away syndrome. So we'll look at some charts there. So let's go move to the next slide, and let's look at these individually and kind of how you might look at these in practice, in actual practice, trying to manage your portfolio, manage your investments. A big deal is major levels often influence major trend direction. last year, since April of last year, I was talking about this level in the NASDAQ Composite Index. Why? It's the top of the tech bubble at 5133. If anybody trades this or watches this index, we hit there 6 times. Now, this is a long-term chart, so you can't see all of the detail here, but there was 6 different times that we took a run at 5133, and we failed every single time. How do you look at this? If you're long the market and you see that it's trying to get through a major benchmark area like this and it can't, maybe this is a time to think about trying to reduce your exposure. It's a warning signal. It's like taking the market's temperature. Is it strong enough to make a new high or not? So you could see that we failed here, which was kind of a warning signal. And now we have the Russell 2000 weekly. And by the way, technology and small cap in that order typically lead the broad market, which is the S&P 500, up and down. So whenever I'm looking for what's the market going to do next, I like to look at the leaders. So I like to look at tech, which is what we have here with the composite, and I like to look at small cap, which is we have, this is the Russell 2000. Now look what happened. After we stalled here in June, here's a coincident high in June that we made in the Russell. Now this pattern here in red, it's called the head and shoulders. It's a very basic pattern. People, I think, make the mistake of seeing this pattern in places where it's not there. The takeaway here is it has to peak from something. So as we're at a major top here in one index, I may look for a topping pattern in another index. That's precisely what happened here. We broke through the pattern, and then we broke through the 09 lows here back in January. What does that mean? It means that this trend is now in question because we stopped at a resistance level here, and now we're breaking support. So that's a sign for investors to be careful. Now, everybody does this differently. Some people being careful means buying a put. Some people it means getting out of the market altogether and looking for another investment. But these are ways to protect your portfolio. In 2008, a lot of people lost their life savings. Just a couple of simple little tools like we're going to look at in these first couple of slides could have saved people a life's work of putting the money in the bank and trying to save for their retirement. So this is all simple tools, actually pretty blunt instruments that can really save somebody in the event that there's an adverse, a significant adverse move in the financial markets. Let's go to the next slide. Price and trend too. Okay, so now that we know what's going on here, you can take from kind of like a bigger picture. Now you go to the daily chart. This is an S&P 500 chart daily, and this chart goes back to mid-March, March 14th here, as you could see. I wanted to use older charts here because all we're trying to do today, teach you how to use these tools. We're not trying to forecast. We're trying to teach you how to use these tools. So right here, we were up against, on March 14th, we were up against the 200-day moving average in orange, shown right here. It's a major trend proxy. You hear people on CNBC talk about it all the time. You know, what's the 200-day doing? It's a major trend proxy. So now you know that we're at an inflection point. In addition to that, the November 16th low was also right at that level, 2019. So what do we know? We know that financial markets typically move from support or resistance level to support or resistance level. So now we can define, okay, from here, we have a couple options. We could either drop down to the first underlying support level. We knew that was 4% under the market at 1947 here, or we could have a run-up to the major overhead resistance level from 2082 to 2104. This is precisely where we are right now. You know, so the market took a turn up. So once we got through 2019, we could say, okay, we know where the next level is. If we're short the market, this is our risk. If we're wondering whether to buy or sell the market, and we're, or say, we're long the S&P 500, we got a pretty good idea of where the market's going. It turned out in this case to work out quite well. So now we're at 2082 to 2116. Excuse me. So now the next thing to do at home, or some of the analysis that we do here for our subscribers, is now we are looking at this level as our price fulcrum. And if it goes through it, Where does it go on the upside? If it breaks, what happens on the downside? I could tell you if it holds here, we're probably going back to 2019 again. Not forecasting, but trying to be aware of where these levels are. Let's go to the next slide. Here's some more price and trend stuff that I think is really important, and it gets into the intermarket analysis a little bit. You need to know what the major areas of the U.S. economy are doing. This is an ETF from the SPDR. It's the retail sector, XRT. Why do I care? For one, it's positively correlated to the S&P 500. I know that because of our database. And number two, I know that retail supports 1 of 4 American jobs. So this is a big deal. This really is something that makes the economy move. So we broke down through a trend line that dated all the way back to November 2008, back in January. What does that mean? It means that this whole trend here is getting tired and maybe coming to an end. It's a red flag. It doesn't tell you to go out and sell all your stocks, but it tells you to be careful because we had a trend that was in place for many years. It's starting to break, and in this particular asset, it has a lot of influence over the economy, and it's positively correlated to the S&P. This chart on the right is really the same thing. This is a PHLX Housing Sector Index. It's another ETF. HGX is its ticker, and housing sector contributes approximately 18% of GDP, so I care. Also, this is another index that's positively correlated to the S&P 500. So I know as go housing and retail, so is likely to go the stock market. If these two areas of the economy are doing very well, it's not going to be good for the economy. It isn't going to be good for the S&P 500, which is supposed to reflect the economy. It's supposed to reflect the U.S. economy. So again, we're starting to break some trends here. It tells you to be careful. It doesn't tell you that you have to get out of the market, in tomorrow, but you're educating yourself on what people that have skin in the game, that have actual dollars in the game, think of all of these levels. Intermarket. We talked about a little bit in the beginning, you have to know what's correlated to what. Sometimes, and this is like a prime example, a certain asset will really dominate asset prices. It will be at the forefront. CNBC will talk about it every 10 minutes. It'll be in your local newspaper, and that's oil prices. Oil prices have been in a huge spiral from $103 a barrel back down here to about $30, $31 a barrel back in February. We've had this big spike higher. Why do we care? Because since the beginning of the fourth quarter of last year, it's been statistically correlated to the S&P 500. It means that stock market investors are looking at oil prices as an indication of global economic growth or weakness. If oil prices fall through the floor and go to $20 a barrel, you don't have a lot of demand to buy oil. It isn't good for the global economy. Stocks don't like that. Stocks go down. Now, this correlation, just so I'm clear, some of the correlations we're going to look at have been around for 25 years. This one has not. This one came into vogue at the end of last year, and it's very much in vogue now. You could see, the correlation here. I actually updated our database yesterday, and the correlation is 0.94 since January, which is pretty close to lockstep. So all this means is if you're looking at the S&P 500, if you're trading stocks right now, you also need to be looking at oil prices because they're going to affect the price of your stocks. Intermarket 2, I talked about certain assets that have a long-term positive correlation to the S&P 500. One of those is the German DAX, shown right here. I only went back to 2000 here, so we wouldn't lose a lot of context when trying to show these two side by side. The DAX is in blue here, S&P is in black, but this relationship goes back to the 90s, positively correlated. We've got a trend line in the DAX that originated in September 2011, pointing to it. And we broke it, again, in January. Note this, January. January is when we broke all these trends in retail, in the Russell 2000 from our first couple of slides, in housing, now in the German DAX. Now it's trying to get back up over this line again, but this is technical damage. This is an indication that the market, in a strong market, is going to buy off of this trend. I should say investors collectively will buy off of this trend in a strong market, as we did here in 2015. Touched this trend, and we were off to the races. We had a huge rally here. This time, it didn't. It broke it. That tells you that the way that investors trading the German stock market look at the world has changed. It's something you should know. Let's go to the next one. Japanese Nikkei 225, another major global stock market. You remember we talked about in the beginning, knowing where your levels are. Look at these, monthly, weekly, daily, and know where your levels are. It's kind of like, the Titanic. You got to look for icebergs. This right here was an iceberg for the Japanese Nikkei 225. April 2000 benchmark high. We came up and tested it in June 2015, right when the comp, that was our first slide, was testing 5133. It failed. It moved downward. This was a sign for anyone that was long the Japanese stock market. You know what? We couldn't make a new high here. There's selling going on here. I need to know that. I need to put that into my investment decision-making process. Look at the correlation here. Going back to 2000 again. Tight and stable all the way through since October of 2015, which is over the past 2 quarters, 0.86, 86% positive correlation since October of 2015. So know it's correlated to the S&P. Know where they are. You don't have to know every movement. You don't have to watch these things minute by minute or day by day, but you need to know if we're coming up to an old high or an old low. Take a look at this, for example. The May 2003 low in the Nikkei. We came and kissed it in November of 08. The S&P 500 made a major bottom in March of 09. If you would have known this and known that we held this support level from here to here and known about this correlation, this would tell you indirectly, you know what, it's time to do a little bargain hunting in the stock market. It's time to look for stocks that I maybe didn't want to buy before, but they were real pricey, and I've been scared to death to buy them since because the market's been going down. This tells you to look for value. So they're really important tools. Simple tools, but very important tools. Let's go to the next one. Here's some more intermarket. Chinese Hang Seng. This is what started the whole thing off, is we had the break in the Chinese stock market back in July, which is right what I'm pointing to right here, which really started the slide in everything. That's when the NASDAQ composite was testing 5133 and the Russell 2000 was making the head of that head and shoulders pattern that I showed you. Once this happened, this was the trigger. Oh no, something's bad's going on in China. Why do we care? Again, look at the correlation here between the Hang Seng and the S&P 500. Tight and stable for a lot of years, 25 years. Since then, we made the October 2nd low. This is important. We tried to get back up over that trend line. Failed on October 30th of last year, and then we fell down to new lows. That's important. That tells you that the people that trade this market think something very important and very bad, or negative. Let's say very bad. Let's just say negative. Let's try to keep the superlatives down. But this tells you something changed. We broke a trend. We tried to re-engage it, and we made a new low. That's the definition of a bearish trend. That's what we see here, and we know what the correlation is. Let's go to the next one. Momentum. There's different ways to gauge momentum. There's short-term, intermediate-term, long-term. You can look at it in a weekly chart. You can look at it in a monthly chart. Here are 2 ways that we use to find out tactical momentum for Asbury Research. And like we told you, tactical for us is 21 business days because it's 1 month. So this is the monthly or the 21-day rate of change in the S&P 500. What the green shows is when it's positive, meaning up above its 0 line that I'm pointing to right now. Positive, then it went negative, right here on December 2nd and caught this move down. We were positive as of the ending date of the slide, which again is a few weeks ago. It's actually exactly, these slides are a month old today. Went positive on February 16th. It is still positive as of this morning. So know if you are trading within a tactical time frame or a monthly time frame, gear your indicators to work inside of that time frame. You don't want to be using an 11-day or a 6-day RSI if you're trying to capture a monthly trend. You know, RSI or a rate of change or whatever the indicator might be, gear your indicators to your investment time horizon. If you take away one thing today, gear your indicators, understand what your investment time horizons are, gear your indicators to work inside of them. Otherwise, you're all over the place and you don't really know. You're looking at a lot of unlike things. You're looking at credit spreads and investor sentiment and all these different tools. The way you make them sing together, so to speak, kind of getting the same kind of rhythm with each other, is by knowing your time horizon and setting your triggers that way. So that's what this is about. Now, this chart on the right is the MACD. It's moving average convergence divergence is actually what MACD stands for. It's the difference between a 12 and a 26-day exponential moving average. That's nice, but what we're interested in is what is it telling us? And right now, or at least about a month ago, and we're still right about here, it's at a peak that it's been at since 2014. What does that mean? It means the market is overextended from, I would call this a near-term momentum rate of change. This would be intermediate-term momentum in our world. So this tells me overextended on an intermediate term momentum basis. Why do we care? Well, these red highlights show the last several times that this has happened. November 2015, Feb 2015, these 2014. It doesn't always pick the top. Nothing works all the time. That's why we look at so much stuff. But this tells you if you're long, you're probably somewhere near the end of the swing that began back in February. So maybe you're more careful. Maybe you tighten your stops. Maybe you don't put on 3 times as much as you put on down here because you're really bullish or somebody on TV said that they're bullish. This tells you what the market is really doing and not what some guy said on television. This is what you need to pay attention to. And I say that, I do a lot of CNBC, but you can't gear what you're doing to what some guy says on television. He needs to be vetted. So you get a lot better answers by looking at data. Asset flows, ETF asset flows. This is the SPX, the cash S&P up top here, and this is the total net assets in the spider down here. Why? Following the money. One of the only things that I know of in doing this for 35 years that actually leads price is asset flows. Why? Because first the person picks, 1 million people pick up their phone, call their broker, tell them to buy 10 SPY. So they buy 10 SPY, the SPY hit the market, then the market goes up. First the flows and then the market, like you're trying to push your car down the street. First comes the push, then comes the roll. So that's why this leads. Look what, and why do I use 21? Because this is a tactical tool for me. So I'm within a monthly time frame, 21 business days in a month. When the SPY, total net assets invested in SPY, get up above the 21-day moving average, drives the S&P higher. It's not rocket science. It's just more buyers than sellers, or not. Every trade there's a buyer and a seller, but there's more positive flows. Excuse me. There's more asset flows there. More of a strong asset flow for money going in than money going out. So from October to November 11th, it pushed prices higher. Now, once those assets started to come underneath their 21-day, and we had some chop in here as people were trying to figure out exactly what was going on at the end of last year, but this is when the party ended, when these assets started to move underneath. Now, back on February 11th, assets came back in and stayed in. As long as these assets stay up above the 21-day moving average, we've got horsepower to push the car down the street, so to speak. When this changes, the game changes, and you need to know that. This is NDX, which is the cash NASDAQ 100. And this is the Qs, the PowerShares QQQ, which is the ETF for the NASDAQ 100. This is even more precise. Up above the 21-day moving average with assets was September 30 to DC9, powered the NDX higher. Right here is when those assets came down underneath their 21-day moving average. Look what happened. Took about a week or two, but that was the end of the party, and we fell down into these lows that we made back in January and February. Then we had flows turn positive again on February 29th. The NASDAQ has been up ever since. So follow the money. You know, you need to know what asset flows are doing. Now, there's other things. If somebody trades futures, you know, you could use total open interest for this. There are other tools, but find a tool, find a means to follow the money, however that may be. Corporate bond spreads, a little bit more of a wonky tool, but a very valuable tool. This is the B of A Merrill Lynch U.S. High Yield Master 2 Option Adjusted Spread. It's a long mouthful, high yield corporate bond spreads. It's the difference in yield between junk bonds and the nominal 10-year. Basically what happens, and again, this is a tactical tool for us, so we're using a 21-day moving average. When there's money, when the spread's narrowing, in other words, the two yields are coming closer together, it means the bond market is relaxed. It's seeing lessening creditor repayment risk for the high yield bonds. The stock market likes it. It goes up. Once they start to steepen, as they did here, between November 11th and Feb 22nd, look what happened to the market. Didn't like it. Took a while. Kind of went flat here for a couple months, and then, you know, the bottom fell out back at the beginning of the year. Spread started to narrow again on February 22nd. And note that asset flows, momentum, everything turned at the end of February at the same time. 3 or 4 different indicators. We're using 21-day moving averages for a tactical trigger for all of those. They all turned right around this February 22nd area. Once the spread started to narrow, you know, the stock market got happy again. This is the same thing here. This is another look at it. Instead of using the high yield, this is the BAA corporate bond spread. So we're using the Moody's BAA corporate bond spread, 10-year maturity, spread against a nominal 10-year treasury yield, and you basically get the same answer here. The timing is a little bit different, but this is just a way for us to check our work, basically. So we look at 2 of them. Volatility. I like the VIX. There's 2 ways to look at the VIX. What I call near term and what I call intermediate term. Let's look at the intermediate term first and then kind of work our way in. This is intermediate term VIX. This is a VIX going back to 2014. This is the S&P 500 up top. And what I've noticed here is for several years, going back, you know, several years back from 2014, I kept it at 2014 so you could see the detail on the chart. When the VIX gets to around 12, which is an extreme in investor complacency here, we're usually at or near some kind of a peak in the stock market. Why? Because when the stock market is totally relaxed, thinks everything's hunky-dory out there, you know, the economy's looking good, no worries, I can go on vacation, that's just when bad things happen. And that's also when investors can get scared the most. It's kind of like if you're walking around your house at night and you're not expecting anybody, and one of your neighbors comes and says hi, and you jump out of your skin. Well, that's what happens when you're at a 12 VIX. So since here, we've actually gotten close to a 12 VIX. We're very close to a 12 VIX right now. So what does that mean? Well, that means that the market is in a position to be afraid. How do you use that? What I do, and let's go to the near term now. Again, S&P 500 up top, VIX down at the bottom. This time I've got a 50-day moving average that's over the VIX. Why a 50-day? I've back-tested this a little bit. The 50-day has worked outstandingly well in the past couple of years for a trigger. What does that mean? When the VIX is underneath the 50, indicating investor complacency, the stock market likes it. The S&P 500 historically has gone up. When the market starts to get jumpy, starts to get a little scared, the VIX gets over the 50, that's the red here, stock market stops going up, eventually rolls down. So right now the VIX is underneath its 50-day as of November 14th. So that means the market is feeling pretty complacent. Here's what we have to be careful of. A bounce off of or near 12, meaning the market is really fearless, and then a move back up above the 50-day here, meaning all of a sudden it got scared. Okay, that's when market tops start, and that's where you get these peaks like we saw back here in May of 2015 or back in November of 2015. So a two-step process from extreme complacency to near-term fear is what really triggers everyone to pick their broker up and say, get me out, I don't want to be in these markets anymore. So that's another tool to use to tell you when you're in a situation where the market can go higher and when you're in a situation where bad things may happen. Investor sentiment. Excuse me. I use a lot of these various indicators. We're going to look at two. And again, these are from back from March 14th, so exactly 1 month ago today. This is the ISC Sentiment Index. The ISC is an online exchange, options exchange. It only measures opening long transaction by private investors. Back in March 14, we were at a least bullish extreme. So that means there was a lot of put buying going on. There was a lot of put buying going on. Historically, when you get a lot of put buying, it's kind of Murphy's Law. When everyone is really bearish, that's usually when there's a bottom. Well, that's kind of what happens here. I highlighted this a month ago, and since then the stock market's gone significantly higher just because, partially because of this phenomenon. When investors are the least positive of the market or the most nervous is usually when you want to start to look for a bottom. So this is kind of a near-term move. This is actually a 5-day moving average of this particular metric, but that's how that works. Now this on the right, I would count this as more of an intermediate-term metric. It's the Investors Intelligence data. It's in Investors Business Daily. It's widely discussed in the financial media. Again, this is a survey of stock market newsletter writers who tend to be a little bit more intermediate term, 1 to 2 quarters out in terms of their investment time horizon. So these guys are a little bit more long term, but they were least bullish, which means they were bearish. Back in the middle of March, these guys were really negative. So I look at this and I look back across the chart and say, okay, what happened the last few times that they were here? Well, August of 2015 was one, that was a low. September of 2011 was another one, that was another low. June of 2010, that was another low. And the granddaddy of all of these was March of 2009. Right here, that was another low. So that tells me when everyone else is hiding under their bed and thinks it's the end of the world, that's when you should be looking for opportunity. That's the message of this chart, and that's why we look at so much investor sentiment data. It's really important. Let's go to the next one. Here's market breadth. We talked about that a little bit in the beginning and I used the example of the percentage of constituent stocks that were trading up above their 200-day moving average. Here's the S&P 500. I'm going to start on the right here because this is the longer-term chart. This is the intermediate-term chart. And the percentage of NYSE composite stocks here down at the bottom trading above their 200-day. It had been down under 20 and just started to rise from underneath 20 back on March 14th. It was a least bullish extreme. It was very weak breath. It was soft breath. Now, if I go and take a look at other times that it's been down this low, Sep 2011, here's March 09, and then all the way back to September of 2002. This is not a buy signal. This is not a time to go out and buy the market and then go on a 6-month vacation. This is a time to look for value and then to look for some of these other more monthly indicators that I was talking about, like the rate of change in ETF asset flows, corporate bond spreads, the VIX. But this tells you to look for value. This is the more near-term version of this. S&P again on top, but this is the percentage of NYSE composite stocks trading up above their 40-day moving average. So this was a little peaky back on March 14th. That said, maybe it's getting a little frothy on a near-term basis, but this was telling you to look for value on an intermediate term basis. So how would I look at this? I would maybe look for a little break in the market, a little sell-off in the market. So you get this down closer to 15% and this at 20, and that's when you know you're at a value area. That's when you look at your 21-day technical tools to see if there's a buying opportunity. Because just because this is low, this doesn't mean you can buy them. This means that there's a value area here, and you need to see money moving into the stock market. You don't want to be the first one on the train. You want to let someone else be your guinea pig and see those asset flows start to expand in some of those ETFs, like the spiders and the cubes, like we looked at a few weeks back, and then you want to get in. It may mean that it means that you're not going to be able to tell anyone at the annual cocktail party you bought the bottom, but it also means you're probably not going to lose all your money because you've let someone else be the pioneer and you're waiting for these asset flows to confirm it's a good idea. Let's go to the next one. Overbought, oversold. I'm not going to spend a whole lot of time here, but again, the message is know what your time frames are and have a strategic time frame, have a tactical time frame. If you're a day trader or if you're a long-term trader, that's going to be different, but know what those are for you. For me, 1 month is tactical. So back on March 14th, the S&P 500 was short-term overbought. It tells me it's a little bit frothy here from a tactical standpoint. But from more of an intermediate term or a strategic standpoint from Asbury Research's point of view, we were coming off of an oversold situation which indicated value, which told me that maybe this February 2015 low is a sustainable bottom, at least sustainable for a quarter, for a couple of months. So again, overbought, oversold, different time frames. Understand what your time frames are for both tactical and strategic investments. Seasonality, we talked about seasonality. This is the most interesting time of the year to look at seasonality, and this is why. Here's our monthly seasonality. It's monthly because we have 12 monthly bars showing me what the S&P statistically has done on each of these months at the close of the month, going back to March of 57. Again, 57 is where the S&P evolved into its current iteration. That's why we use that date. And what it shows is that March and April are the fourth and first seasonally strongest months of the year in the S&P 500. And we also take this a step further, which I can't get into right now, but we also do a second study, and that's what this red line is, and that tells you the percentage of the time that there was a positive close in that particular month. So in April, it's not only the strongest month of the year, and this will tell us on our charts, it will show us percentage-wise what's the average percentage gain in the S&P 500, and the red line will tell us since 1957 what percentage of the time was there an actual positive close. So we have the strongest month of the year on a percentage gain basis, and we also have the most positive closes for any month during this period. So that tells you April is a good place to look for a top. Now, this goes back to March, so we're not going to talk about this. I'm going to talk about a chart now that's just like this one, but you can't see it, but I'm going to explain it to you. So then we take these data and we move it to a quarterly basis. We do this via the same steps, but now we've got 13 bars for the 13 weeks in a quarter. The second, or the third week of April, which is next week, is the seasonally strongest week of the entire second quarter. So you put both of these together, and you could say next week is when we seasonally peak for the year in the S&P 500. Does that mean it has to peak next week? Absolutely not. These are statistics. The market's a dynamic thing. But it says over time that there is a very definite pattern here. April peak, sell in May, and go away. A bottom in September, and always a strong fourth quarter. Or historically, there's been, on average, there's been a strong fourth quarter. So know your seasonal patterns, especially when you're at big inflection points like we are in April. Next. This is our own metric. I built this 3 years ago for sectors, sector rotation. And basically what it does is, I'm going to start one chart over and then we're going to go backwards. This is based on asset flows on the 9 original sector spider ETFs. I've got data on this going back to 2006. On average, this is the average daily distribution of assets invested in all 9 of these. So on average, going back to June of 2006, the financials comprises 20% of all assets. Healthcare is 9, industrial 7, and so forth. This is a snapshot as of March 11th. And this shows, so now you compare this to this, and you can see what's underinvested and what's overinvested. The materials sector at that point was only 2% of the sector pie compared to an historic 5. Energy sector, only 14% versus an historic 20. Both of these sectors have done pretty well over the past couple of weeks. Part of the reason is because they were historically underinvested. The overinvested ones, consumer discretionary, 11% of the sector pie now, compared to 5% historically, so it's very overinvested. Second, healthcare, 13% compared to an historic 9, and so forth. Now we'll go back here, slice and dice this a little bit further. So now what I do is, in this column, this is the percentage through the end of business on March 11th that each of these particular sectors comprise that pie, 18.1% for financials, 14.2% for energy, so on and so forth. Now this is where they were 1 week ago, this is where they were 1 month ago, and this is where those percentages were 3 months ago. Why do I care? Because I want to see movement. So basically over the past week, again, I'm talking about data that's more than a month old now, but for this particular time period, over the previous week, the biggest inflows over that past week came from staples. The biggest inflows over the past month came from energy. The biggest inflows over the past 3 months or 1 quarter came from the utility sector. Outflows the same. Biggest outflows came from financials over the past week. Over that previous month came from healthcare. Healthcare was overinvested. We saw by the previous pie chart that it was overinvested. Now you see some asset flows actually coming out of healthcare. Over the past 3 months, financials. Financials have taken it on the chin big time over the past month. Part of that was because you had 1 week and 3 month outflows that took place 4 or 5 weeks ago. That portended weakness, and we saw this, where financials really got hit hard over the past month. So that's how that works. These are our own in-house metrics that we try to figure out where the money is going and then follow it. So those are our tools. We're just about at 55 minutes. So again, we have now expanded, so we are now offering services for individual investors. If you're interested in getting more information, here's how you contact us. Feel free. We'd love to talk to you. And now I'm going to turn this over to Cynthia to see if we have any questions. Okay, here we go. We got a question from Alex G. What price frequency do you use when computing the correlations you showed us today, and why? It's a great question. Thanks for asking it. We start out with 10 years, and then we go to 5 years, and then we go to 3 years, 2 and 1 year, and then I look at the past 2 quarters, because a mistake a lot of people make when they're looking at correlations is, like if they're talking about gold and the US dollar, they may say, gold and the dollar have been inversely correlated for the past 20 years, and they have. But they haven't always been correlated over the past 8 quarters. So if you're trying to make an investment decision based on something that's been in effect for 20 years but is not in effect now, you're using the wrong criteria to try to make that decision. So in other words, simply stated, I want to see something that has some history. I want to see something that just didn't turn up last week, because it's very easy to confuse correlation does not mean causation. So I want to see something that's a well-established correlation, but I also want to see it in effect now. So that is something that now is more important from a trading perspective than it is, you know, to know what something did over the past 10 or 20 years. Okay, let me take another one here. What is your minimum account size for individual investor accounts? That's something we really don't want to get into here. You know, you can contact us or IB about this at a later time. Correlations. Somebody wanted to know, what other correlations are you watching right now? And I actually have a little cheat sheet here that I'm going to go through some of these. Something that has fallen out of correlation recently, but something you want to keep an eye on, is the correlation between the yield of the 10-year note and the yield of the S&P 500. It falls in and out of correlation because what drives the correlation is when the stock market starts to go down. When the stock market starts to go down, you see a kind of a mass exodus out of stocks and into something safe. And into something safe is usually first treasuries and secondary gold. So when the stock market starts to move lower, keep in mind that there's going to be a natural asset flow going into the bond market, and that's something to be aware of. And also, if the stock market starts to move higher very, very fast, like at the February lows, there was a big asset allocation situation that basically went on there for 2 or 3 weeks after that happened. It was a lot of the money coming out of, you know, the money market and the bond market and gold and going back into riskier assets. So that's one that's not in vogue right now, but one you should be aware of. Here's another one I'm looking at. Dollar yen and the yield of the 10-year. That has been in vogue for some time, and it's something to watch. The Nikkei 225 and the yield of the 10-year. So if you're looking at the 10-year, these are other places you can look to see if you see a corresponding, you know, indication to either be buying or selling that asset. The reason, you know, for the Nikkei 225 and the TNX, and again, that's one that's been around for 20 years. It's not always in vogue. It had fallen out of favor, out of sync for about a year, and now it's coming back in again, is because Japan is one of the U.S.'s largest trading partners, and you know, the relationship between the buying and selling that goes on between those two countries, you know, the trade that goes through those two countries, what affects their stock market often affects our interest rates. Is there any more questions? We're right just about at 1 hour.
Well, John, what I would like to do is actually take folks into the Trader Workstation and show them where they can access Asbury Research. So what I'm going to do is grab the ball back from you at this point, and let's take just a couple of minutes and we'll go into our Trader Workstation. Now notice, everyone, your screen is going to blank momentarily, and I do want to let's see, but here we have it. I'm actually first going to start off with account management, because if you would like to access any of John's research, we do have a free 30-day free trial subscription. Now, I've logged into my account management system, and notice I'll go to Manage Account, and down here to Trade Configuration, and then into the Research Subscriptions. Now, you'll see this page starts out with our interactive broker information system. There's a bundled package, but as you scroll down, you'll find beneath the premium news providers, there's analyst research. And I'm going to scroll down here till we get to the Asbury, let's see, here we have it, Asbury Research. Now, there are 2 different subscriptions that are available, and by the way, you'll be able to see the monthly charges here, but I've already subscribed, but notice here, there's also a free 30-day trial period. So if you'd like to give it a try, simply put a check mark in this box. Some additional information is available here. Now, by simply hovering over the hyperlink for Asbury Research. Now, once you've subscribed, I'm going to come into out of account management and into the trader workstation, because underneath the analyst research, you'll be able to find, for example, here we have Asbury Research, and here are the different documents that are available. Now, I've already got one that's opened up, and I'm going to take you out there, and you'll see, well, first of all, we have the information displayed here, and I did want to quickly scroll through and notice this is as of the same time period. But you can find this directly through the Interactive Broker platform, so I did want to make mention of that. Okay, now also let's go ahead. We're going to close out of this. I'm going to take you back into the main event window to see if there are any additional questions here. If there are, go ahead and enter them into the chat panel. But while we're waiting for, oh, Leo, certainly, go ahead and type your question in. Looks like Leo wants to get a question in here as well. Oh, one other item, Leonie, minimum account sizes. Now, that's probably not a question for John, but let me quickly take you back into our desktop share one more time, because I did want you to see where you can find that information out on the Interactive Broker website. Let me simply minimize here. Oh, did I turn that? We'll go back to the website, and what I did want to point out, notice that underneath our pricing menu, there's a section here for account minimums, those required minimums. And here is where, by simply clicking that link and then scrolling down, you'll be able to access any of the information down below. So, Leonie, take a look at the different account types and see what those required minimums will be. All right, so with that, let's get back into our main event window. It looks like John has dropped off here today, but I see that, oh, okay. Let me see. Oh, okay. Oh, you meant the account minimums for John's research. We'll take a look at the research that is available. Okay, also, let me see. Oh, let's see, can't hear you. Oh, goodness. Oh, okay. Oh, well, Leonie, for anyone else, that's actually what we do have available. Well, with that, I'm not seeing additional questions come in other than someone who has asked, will you be able to get a copy of the presentation? So what I'm going to do is actually let you know that the slides that John has been using for today's presentation will actually be pop up as you exit today's event. So so be on the lookout for that information as you do drop off today's call. But before you do, I've got actually one piece of business IB's management requires in each of these events, and that's to run a poll. So you'll notice I've just put up a very quick poll on your screen, and I do ask your help in making the selections. By the way, 2 of the questions are multiple choice. So we try and make this quick and easy. But also notice that in number 2, there's an input field, and that makes a great place for you to put any comments or suggestions on other topics you'd like to see covered. But poll's about to end, so everyone please click submit, and thank you. That feedback really is very helpful. Now, by the way, also a reminder that we have been recording today's event, and I'll be sending out a direct link to today's recorded playback soon after today's presentation ends. So if you want to re-listen or review any of the concepts that John did discuss today, simply watch your email later on this afternoon. And don't forget to either bookmark or download and print the slides as they pop up after today's event. Well, with that, looks like we have come to the end, and I want to thank all of you for participating with us here today, and especially thank John Kosar with Asbury Research for our presentation. By the way, both the presentation and the webinar notes will also be listed on the Interactive Broker website. Underneath the Education menu, there's a webinar section, and you'll be able to find today's event plus any of our archived presentations underneath the recorded button. John's presentation will be listed under the Industry Sponsored tab. So thanks, everyone, for joining us here this afternoon. Have a great day, everyone, and all remember to trade smart. Thanks, everybody.